This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun, our CEO. And wow, Joe, third quarter is finally over. I mean, we had horrible performance, asset categories moving in directions we didn't expect. I mean, it was just wild and woolly.
Yeah, it was not a fun quarter. Things all over the place. You started the quarter in a rally up, I think, 14 from July 1 into the highs in mid-August, and then down 17 to the lows. But, we're back basically at the lows of June. I don't know that necessarily we're going to go any lower. I obviously can't predict that. Nobody can. But I was told, somebody told me, oh, well, we broke that June low. And it's like, well, yeah, we did by a few, points on the S&P. I was told a long time ago by a very smart guy in technical analysis that you should always draw trend lines with a crayon. He's like, this is not exact science, pal. So I think we're basically at the lows of June. We'll see if we come out of that. Look, we'll see. I mean, I think there were a lot of things that in the quarter that maybe reached some extremes, put it that way.
You've been an investor for 40 years. Is sentiment as bad as you've ever seen it, or is it worse?
Well, it is stunningly bad. In fact, it's interesting too. I think that it depends on where you look. I mean, look, we've seen, just to take an example, the number of stocks above their 200-day moving average in the S&P. And that number is like, I don't know, 14, whatever it is right now. Well, we've seen the numbers a lot lower. And at the low, by the way, we went just a little under 10 on that back in June. And it's interesting that we made these new lows. We didn't make a new low on that, though, which is kind of a technical divergence that looks like a positive. It could be. But, those numbers, we've seen those numbers a lot lower in 2008. The question is this something like 2008? And I don't think from a financial or an economic standpoint, it's anything like 2008. So we were getting sentiment type things that are similar to what we've seen in a financial crisis. And we're not anywhere near a financial crisis. That's not where we are. I spent a little time on Twitter over the weekend, and everybody's talking about Credit Suisse and how Credit Suisse is on the verge of going under. And, their CDS, their credit default swaps are at like 250 basis points. Yeah, so are GM's. I don't think GM's going bankrupt. People are just kind of losing their minds. Just, I don't know. They're grasping at anything and saying, oh my God, this is going to be like 2008. And I think this comes back to recency bias, something we've talked about before. People always latch onto the last thing and think that, this war is going to be just like the last one. And it's not. Every one of these bear markets I've been through in my career, that's, I think, 6 of them. The first one was the 1980 bear market. I was only 19. I didn't have a lot of money, but it was mine. And I sold out at the bottom. I mean, that was my first bear market. I didn't know what to do. But I think that every one of those 6 bear markets were different in some way. And they were also very much alike in that people react the same way. They get most scared at the bottom and most ecstatic at the top. And that's just the way it goes. So are we at maximum pessimism, peak pessimism, which is what I titled the piece this week? I don't know. It's very, very pessimistic out there. I'll put it that way. Could it get worse? I suppose it could, but I don't really see why it should. But, people are not rational about these things a lot of times. And so we'll have to see where it goes.
Well, in times like this, people just want to jump in bed and pull the covers over their head. But
They just want to feel better. They want to feel better. That's what it is. It's like, I just want this to stop. And the easy way to stop is to go buy a T-bill or something and you can sleep. But it's not necessarily the right thing to do.
Well, here's a quote out of your report this week. You said, bear markets and negative sentiment are exactly what a long-term investor should hope for.
Yeah, look, it's hard. Let's not kid ourselves here. Being a buyer or being optimistic when everybody else is pessimistic, doing what Warren Buffett says, which is to buy, to be greedy when everybody's fearful, to do what Sir John Templeton said, which is to buy at the point of maximum pessimism. It is not an easy thing to do because you're going to be out there all by yourself. It is hard, but it is exactly what you should be doing. If you believe, as I do, that ultimately the United States is a great place to be from an economic standpoint, from a freedom standpoint, from so many different ways, that we're always going to find a way to get through to the other side and be better. If you believe that, then I think you got to be a buyer in bear markets, and it's not easy to do. Now, look, there are people out there who say that, this is, we're like the fall of Rome here, and things are going to do nothing but get worse. I can't live my life that way. I'm an optimist. I can't help it. It's the way I've always been. I think it's a sad way to live, to be a pessimist and think that everything's going to come down around your ears. We've certainly got some problems in this country. I think some political issues. But you know what? We've had these things before. We've had polarization like we have now. We've had people talk about the press and about, the press is very biased and so forth. Yeah, have you heard of yellow journalism? This is not new. None of these things are new. Maybe some people are now experiencing or realizing it or experiencing it for the first time, but they're not new. And we've always come through and been better on the other side. And I think that'll be true again. So if you have that ultimate optimism, especially about being an American, then I think you have to be a buyer in bear markets. And that's it's not an easy thing to do, but it's what you have to do. Like I said, I can't live my life as a pessimist.
All right. So if now's the time to be a buyer, I know you're not a fan of the S&P 500. Haven't been for quite a while.
Yeah.
Where do we look?
Well, I think there's a number of things to do here. Small and mid-cap stocks are cheap. And I don't mean they're cheap, because they're cheaper than the S&P 500. I mean, they're cheap. You're talking 10 to 12 times earnings for the S&P 600 and the S&P 400. That's the small cap and mid cap indexes. These are cheap numbers. I don't really care what period you look at. Can you find lower numbers in history? Yeah, sure. I can find a 6 or a 7. I got to be at the bottom of a depression or something, but I can find them. Yeah, but 10 times earnings, 12 times earnings, that's a cheap number. Considering the growth rates in both cases, earnings growth is higher than those PEs. That's what you look for. That's what we're always looking for. We're looking for growth rates that are higher than the PEs that we're paying. That's a positive situation to be in. So you can look at small and mid caps. Listen, I know it's been a long time since international things outperformed, and there's really lots of reasons to look at international and go, my God, why would I want to do that? Considering what's going on in Europe and so forth. But the fact is that when you have currencies go down as much as they have, I said in the piece, one of my mentor when I got in this business, a guy named Larry, who had been a trader for his entire life, 50-year career or something like that, which at the time seemed like a long time and now seems like, wow, I'm closing in on that. But at the time, it seemed like he was the oldest guy on the planet. One of his rules, and he had a bunch of them, was always buy stocks in the country that just devalued. Now, look, we lived in Miami, so that applied mostly to Latin America. We were always looking to buy in Brazil after the devaluation. And there's very simple reasoning. The bottom line is you're buying things on the cheap because the currency went down. It's no different than the Big Mac index that The Economist puts out. There are times when you can go buy a Big Mac in Rio for a lot cheaper than you can buy it here. And the same thing is true of all assets. And so after countries devalue, you want to be looking at those assets because you can buy them on the cheap. It also there's an earnings impact there too, so it's kind of a two-edged sword. But the point is that the dollar has gone up a lot. So basically, the entire world is devalued against the dollar. Now, we do want to be specific. We want to look for currencies that are undervalued, and you can do that by looking at things like purchasing power parity and so forth. You do that, the euro and the yen right now are 20% undervalued, roughly. Now, purchasing power parity is a valuation technique that it's no better timing tool than price to earnings ratios or Cape-Shiller or whatever. They're not great timing tools. But if you buy an undervalued stocks in a country with an undervalued currency, you look 3 years out, your outperformance on the equity side is huge. You could be talking 6, 7, 8, 9% a year outperformance over the S&P 500. So that's a place to look. Is it time to buy them yet? I mean, look, the dollar is still strong, so I don't think it's necessarily time to be buying those right this minute. Maybe you want to wait to start to get a little momentum with the dollar falling. But if that happens, those things are very, very cheap. And by the way, you look at IFA, the international index, it's cheap like small and mid caps here. Europe is even cheaper. Emerging markets are even cheaper. So now emerging markets are a little trickier on the currency thing, by the way. Currencies can go down a lot in emerging markets and still not be undervalued. So you have to be careful there. It's not as easy as it is with the developed economies where you're comparing two like economies. Comparing the European economy to the U.S. economy is kind of two developed areas. Comparing us to Colombia, for instance, is not probably a very good comparison. But anyway, the point is that there are cheap stocks out there. There are cheap assets out there. You just got to go look for them, and you got to look outside the S&P 500.
Well, whether we're at the point of maximum pessimism or not, your advice is stay positive, stick to your strategy.
Yeah, look, that's the thing too. The strategy that we employ, our Fortress strategy, which is just a diversified portfolio of large and small cap stocks, real estate, REITs, commodities, gold, and bonds, that's our strategy. That is something we stick to all the time. And we stick to it because we've got 50 years worth of data that shows it works in a variety of economic environments. It worked in the 70s when it was inflationary. It worked in the 80s and 90s when it was disinflationary. It worked again in the 2000s when it was inflationary again, and it's worked over the last 10, 12 years as well. It does tend to work a little bit better in the inflationary environments, which is one reason we think that we have the right strategy right now. We do think we're going to be entering and staying in a period of higher inflation. Now, I don't want to say that. I want to be clear about that. It doesn't mean high inflation. I'm not talking about getting up to 10, 15% inflation, but I am talking about higher inflation than we've experienced over the last 40 years. So that environment should favor the strategy that we use. It's been a tough year, though. Real estate generally outperforms an inflationary environment and hasn't this year. But these things are tendencies. They're not, carved in stone. But we do think we have the right strategy. You just got to keep applying it. That's all.